Hello everyone, I'm Yazan Ibrahim, or as some of you might know me, Yazan Abu Ghosh. Today we're going to dive into a fascinating and essential topic, Fraud Examiners, Section 2 Law 2.3 Bankruptcy, Insolvency. Fraud. Today's deep dive into the world of bankruptcy, insolvency, fraud. Whether you're an aspiring fraud investigator, a business owner, or simply curious about how organizations manage their finances, or if you are auditor, this journey will shed light on the often complex systems that drive decision-making. Bankruptcy fraud, a fascinating and complex subject, represents one of the most intricate forms of financial crime. This video will take you through an engaging and in-depth exploration of the bankruptcy process, the fraud schemes that exploit it, prevention and detection measures, cross-border complications, and even the regulatory principles guiding insolvencies worldwide. We'll navigate each idea with clarity, using stories, vivid illustrations, and accessible explanations to bring a seemingly mundane topic to life. Let's start with the basics. Bankruptcy itself. Imagine this as hitting the reset button in the financial world. When an individual or a business can no longer manage their enormous pile of unpaid debts, bankruptcy emerges as a structured opportunity for resolution, often granting relief from certain liabilities while enabling creditors to recover as much as possible. It's like a controlled demolition of financial obligations, orderly dismantling rather than chaos. But amidst this reconstruction, opportunities for fraud frequently lurk under the surface. The shadows of bankruptcy fraud. Now picture a cunning player who bends or outright breaks the rules for personal advantage, knowing full well that billions flow through bankruptcy systems annually. Fraud in this domain often begins with false or misleading statements, a sleight of financial hand meant to obscure assets or intentions. It's a criminal act, often intricately planned, exploiting the very system meant to reset honest debtors' lives. Take, for instance, concealed assets, the poster child of bankruptcy fraud. Imagine a debtor meticulously stashing away properties, piles of cash, or even books and records in an effort to shelter them from creditors. Here's how it plays out. They file for bankruptcy and, with a poker face, claim to possess significantly fewer assets than they actually own. But like an iceberg's hidden bulk, these concealed assets can sometimes come to light during investigations, reminding us of the elaborate lengths people go to in concealing the truth. And then there's the dramatic tale of a planned bust-out. In this scenario, a business emerges from nowhere like a shooting star, dazzles suppliers with a facade of creditworthiness, buys inventory on what can only be described as a spending spree, and then, pop, vanishes into the bankruptcy ether, leaving creditors high and dry. It's premeditated chaos, often orchestrated by organized crime, giving us a glimpse of how deceptive appearances can be. Other schemes are equally devious. Take fraudulent conveyance. Assets are hurriedly shuffled from the debtor's name to associates just before filing for bankruptcy, like a magician making coins disappear. Or consider the strategy of multiple filings, where a debtor exploits legal loopholes across jurisdictions, filing in different locations to keep creditors tied in knots. But perhaps the most dramatically tragic, credit card bust-outs, where individuals pile luxury expenses and cash withdrawals onto cards with zero intention of repayment, relishing the high life before creditors catch on. In this world of financial fraud, creativity abounds. Essential players in the bankruptcy drama. Let's shift focus now to the main actors in this drama: debtors, creditors, courts, and trustees. Debtors come to the table as individuals, partnerships, or corporations grappling with financial ruin. They navigate different routes such as liquidation, where their assets are sold, debts discharged, and they aim for a fresh start, or reorganization, which is akin to rebuilding on the same foundation, allowing them to carry on operations under a new financial structure. It's an intricate balancing act where their legal and financial strategies determine their future. On the other side stand the creditors, ranging from secured creditors, whose claims rely on collateral like homes or cars, to unsecured ones who wait in line after secured creditors take their share. Some jurisdictions even introduce a category called preferential creditors, often employees or tax authorities who jump the queue despite not holding collateral. This hierarchy is a critical element of bankruptcy proceedings, reflecting how the financial ecosystem prioritizes different stakeholders. Oversight over the entire process lies with the courts. Whether it's federal bankruptcy courts in the United States or local county courts in the United Kingdom, the judiciary ensures the system runs smoothly. Allied with these courts are various bankruptcy agencies like the U.S. Trustee Program, USTP, or Canada's Office of the Superintendent of Bankruptcy, OSB, which add an administrative backbone to the process. And in the center, the trustees, a special breed of impartial professionals, manage the bankruptcy estate, often serving as the crucial neutral party that mines through the rubble to salvage assets for creditors, the art of prevention. Our journey into bankruptcy fraud wouldn't be complete without discussing how we can combat it. Prevention is no small task, but starts with creditors doing their homework. Evaluating clients, verifying financials, and visiting business locations. Red flags like unusual purchase patterns, floating checks, and overstretched credit terms aren't just coincidences, they're breadcrumbs leading to potential fraud. For financial institutions, fostering vigilance is more than policy, it's survival. A global stage, the complexity of cross-border bankruptcy. Zooming out, consider how globalization adds another layer of challenge to the bankruptcy process. When a company has assets or creditors across multiple borders, suddenly a single bankruptcy isn't enough to settle disputes. Enter cross-border insolvency regimes, legal frameworks that untangle these international webs. These systems aim to prevent chaos, like foreign creditors fighting over scraps, by establishing efficient cooperation between jurisdictions. The UN Central Model Law on Cross-Border Insolvency serves as an internationally recognized standard, adopted by global economies like the United States and Japan. Its principles guide countries in crafting synchronized policies to resolve complex financial collapses across borders. However, gaps remain. Many emerging economies lack robust frameworks, putting creditors and debtors alike into legal gray zones. As globalization continues to grow, solving this puzzle remains increasingly crucial. Guiding principles: the World Bank and insolvency systems. As we close, let's reflect on the World Bank principles, a gold standard for effective national insolvency systems. These principles stress transparency, fairness, and adaptability in addressing insolvencies, balancing immediate creditor recoveries with longer-term economic stability. Whether it's fast liquidation for doomed institutions or detailed reorganization plans for salvageable ones, the goal is always to maximize asset value while protecting systemic integrity. Anti-fraud measures play a central role here, enabling administrators to unwind suspicious transactions and compel the disclosure of vital information. Ultimately, the tale of bankruptcy fraud is both a cautionary narrative and a testament to the complexity of managing modern financial systems. With vigilant enforcement, sound policies, and international cooperation, the risks can be mitigated. But the fight against fraud in this domain is far from over. Thank you for watching, and as always, continue learning. Stay curious, and we'll see you next video.